This material has been reproduced and communicated to you by or on behalf of Deakin University in accordance with Section 113P of the Copyright Act 1968. The material in this communication may be subject to copyright under the Act. Any further reproduction or communication of this material by you may be the subject of copyright protection under the Act. Do not remove this notice.
Okay, let's get started. Okay, let's get started. Good afternoon, everyone. Welcome to our week 2 class. So first of all, my apologies for my voice. I lost my voice on Saturday, so I'm still recovering it. Okay, so if I'm not clear, if you couldn't hear me or it's not clear, please raise up your hand immediately. I will try my best to repeat and slow down and clarify. Okay, so just in case I'm not that clear. Okay. So from today, last week, we introduced very basic, elementary, the concept in finance, such as the objective of companies or the tax issues, right? But from today, we're going to spend 2 weeks on learning and exploring the most important concept for entire finance, that is called the time value of the money. Okay, and this is the learning objectives we aim to achieve. So by completing today's class, hopefully we can get a tick for all the boxes here. Okay, so there are 2 related objectives today. First, we aim to understand why money has a time value. Okay, so we aim to understand why, answer this question. Second, we want to clarify the measurement issue. If the money has a time value, that indicating the value of the money is varying, is changing over time, right? And then we need a scientific approach to capture this value variation along the time dimension. Okay, so after we understand why money has a time value, we're going to talk a lot about the measurement issue. Okay, So by learning the measurement issue, we have to deal with a bit of mathematics. But as I already promised, we know that nobody likes math, including me, but I try my best to make the process as smooth as possible. And also, when we talk about the math, we will be addressing the intuition behind, rather than focusing on the calculation itself. Okay? And in addition, we will be using Excel to do the calculation. Okay? So I understand that for finance students, the modeling skill is very important. So at the first year level, I really want to share with you guys some preliminary modeling approach using Excel. Okay, so while we also provide instruction how to use the financial calculators, but please trust me, the Excel is a way better toolkit than the financial calculators. Why? Because we have a lot of the convenient function has been built, programmed in the background so that we can directly borrow those functions to solve financial problems. Okay, so that is the introduction, the game plan for today's class. Okay, let's make a baby step and answer why the money has a time value. Okay, that is the first issue we need to clarify. Okay, so before we talk about the time value of the money, I really want to ask you guys a question. What is the money? So we all like money, right? But what is the money? Any suggestions from the audience? What is money? Something we like, but why? It seems to me that you guys don't like money. Yes, please.
Currency or exchange in terms of value?
It is a currency, right? And it's issued by the sovereign government, right? And what is the key function of the money? You got a punchline there. What is the key function? Why do we invent money? Why do we introduce money? Think about it. In an economy, we don't have money versus an economy we have money. What is the key distinction between these two economies? Think about what was the economy like 20,000 years ago. Any idea? What is the key function of the money? Transaction, exchange, right? So this is the punchline. We use money for shopping. That means we exchange something, right? Yeah? But in economics, this process is called consumption, right? So why do we like money? Because we can use money for shopping, right? But it still doesn't understand, it still doesn't answer why we like money, right? But from shopping, after shopping, I'm sure that you guys feel happier, right? And then let's just introduce a little bit economics, okay? So we use money for consumption, right? So for average people from consumption, we derive what? The utility, right? So the utility function for any human being should be increasing. With the additional amount of consumption, we are feeling a little bit more happier, right? That is the key function for the money, right? So essentially, money is a commodity. Okay, so money is a commodity. It stores value, right? It is the same as this pointer. It is a commodity. It's the same as this phone. It is another commodity, right? But the unique feature for the money as a commodity is we can use money for consumption. Is that clear? Right? And then let's talk about why money has a time value in it. Okay? So suppose, think about this simple, very simple example. I have been working in my garden, like in a hot summer, okay? And after I finish work, I found a coin, right? And then you can imagine how thirsty I am, right? I'm going to use the coin to purchase, to buy for consumption, to buy me a Coke, right? And then before I insert my coin to the vending machine, my neighbor is approaching me and he requests me to borrow $1. Should I lend my dollar to my neighbor? If I lend my money to my neighbor, right? Essentially, effectively, what happens is I have to give up my consumption now. Does that make sense? I have to sacrifice receiving the utility. I'm thirsty, I'm hot, I'm tired. I desperately need the consumption, right? But if I lend money out, essentially, effectively, I have to postpone my consumption process. I have to wait receiving the utility, right? So what do? If you want to convince me for this investment lending decision, I have to be compensated. Does that make sense? Right? If they want to borrow the dollar for a week, right, I have to be compensated, right? And I know that next Sunday I will be working in my garden again, right? So should I charge the same $1? Not really, because I have to be compensated because I delay my consumption, right? And maybe I request 1.5, a bigger bottle of Coke for delaying my consumption. Comes to next week, Sunday, I'm going to drink a bigger bottle of Coke for delaying my consumption process, right? So essentially, if we use money for investment process, in this case, we postpone receiving the utility, right? So from which we have to be compensated. And that is the key economic reason why that money has a time value. Does that make sense? Right? But is that all? Is that all we need to know about the time value of the money? Not really. What else we need to think about? So now everybody knows that for most of the Western countries, we are running a high inflation, right? But what is the inflation? The inflation is a measure for what? The cost of living, right? The basket of goods and services we need for the normal life, right? So I'm expecting, we know that we have a high inflation figure, but come to the next week, even the same Coke is going to cost me $1.10, right? So if I postpone this process, I have to factor in the potential expected inflation, right? I have to be compensated to be fair, right? So the second consideration is I have to think about the inflation, right? So by the way, inflation is a measure for the purchasing power of the currency. So as the inflation is getting higher and higher, and that means in economics, the purchasing power of the currency of the money is diluted, is getting weaker, right? So when we make the investment decision, we have to factor in the inflation as well. Okay? Does that make sense? What else we need to consider? What if my neighbor has a bad reputation? This guy borrow money a lot, but we pay nothing. So that means if I lend money to this naughty boy, then I have to bear the risk, right? So as a rational investor, the higher the expected risk, higher compensation I have to ask in the first place, right? So if I know that the investment going to involve high level of risk, in this case, I have to ask the high level of return in first place. Is that right? Therefore, we should also consider the potential riskiness that involved during the process, during the investment horizon, right? So combine all the factors together, then we have a conceptual understanding, conceptual explanation why money has a time value, right? And because of this, let's just go back to the first slide. And this is indeed the building block concept for the entire finance, right? So in finance, we try to learn how to make the optimum decision, right? So here we learn how to make a good investment decision. When we talk about a good investment decision, we have to make sure that the investment project we are making is able to generate the economic profit, not accounting profit. We don't care about accounting profit here. For finance, we care about the economic profit. Remember, to calculate the economic profit, we have to take into account the timing of the cash flow, right? Because we know that money has a time value. $1 today is not $1 tomorrow, right? So we have to learn the time value of the money, right? And then we just provided the economic explanation why money has a time value. Okay? Is that clear? Can we move on? Okay, great. So essentially, in a simple word, what is the time value of the money? It means that $1 today is not $1 tomorrow, and $1 today is not $1 yesterday, right? So the value of the money is changing, is varying over time along the time dimension. Okay? Now let's talk about the measurement issue. How do we measure the time value of the money precisely? Okay? And before we do this, let's just clarify some terminologies. Okay? So usually, for most of the time, in finance, when we measure the rate of return or interest, we always quote the number in terms of the percentage. Okay? And usually, the convention is that when we talk about the interest, the convention is we quote the interest rate in terms of per annum. Okay? So that is the rate of return we are expecting over a year. Okay? So this is called per annum. Okay? And hence, interest reflect the cost of the money. Okay? That is the benchmark, the component, when we talk about the time value of the money, right? And in addition, we need an additional risk premium. Okay? For things such as inflation risk or the potential like the credit risk, the guy never repay me. Okay? Those sort of a risk we should take into account, right? And hence, how much interest we charge reflect the total risk, expected risk of the project. Okay, is that clear? Okay, great. Okay, here are some terminologies. Nominal interest rate, what is that? This is the interest rate we can observe from the market. Okay? Say, if you observe the term deposit rate is 5%, say at CBA, okay, and then we know this is a nominal interest rate. The nominal interest rate is in contrast from the real interest rate. Okay? Well, we don't observe real interest rate directly, but we can calculate the real interest rate indirectly. Okay? So for example, the RBA, the central bank, they set up the cash rate, the benchmark rate, right? And we know that there is like little risk, the credit risk involved here, because we're talking about the transactions among big banks. There's a minimum level of default risk. So only risk there we know is inflation, right? So after we minus the inflation rate from the benchmark rate, then the remaining part should be the real interest rate. But we don't worry about the real interest rate much for this unit level. Okay? So let's just clarify those terminologies. Okay? So we have a nominal interest rate. It is what rate we observe from the market, right? And what about the principal? That is the value of the money we have as of today. Okay? So timing is really important. Okay? And time to maturity, what is the time to maturity? That is our investment horizon, the term of the investment cycle. Okay? So the time to maturity can be in terms of the year or in terms of any different frequencies, such as weeks, or quarter, or months. Okay? What about the present value? And that means the value of the money we are measuring today at the present. Remember, always remember, the value is changing, is moving along the time dimension. So the present, it is value as of today. Okay? And we can also have a future value. Okay? That is, we bring the present value along the time machine. As we are traveling along the time dimension, if we bring the money today into a future date, then the value we observe on a future date is called a future value. Okay? That's very easy. Yeah? So now basically this is our objective. We want to understand and learn how does value change, vary along the timeline. Okay? Say if we are bringing a value from the present value to a future day, here we are calculating future value. If we're traveling along the timeline, right? If we travel, if we move backwards, if we move the value, projected value in a future day backwards, then we are working from future value to the present value. Okay? We just want to get the intuition, the very basic stuff right at the beginning. Okay? Now, here we have some very simple practice. Let's take a look. We borrow $500,000 through a 25 years mortgage. So the question is, for this 500K, is that a present value or a future value? Always remember the timing we observe this money. Is that a present or future? Should be present, right? So that is how much we borrow today. This is how much we received from the bank today, right? And basically we need to repay this loan over a term of 25 years. Okay, very good. Next one. So we want to cash out a 10K from a lottery ticket. Is that a present value or future value? Present value again, right? So this is the money we want to do today. We want to cash out today. Always identify the timing in first place. Okay? And what about the next one? So we estimate that we need $2 million when we retire in 20 years to maintain our lifestyle. Is that a PV or FV? That should be the future value. We don't need that money now, but based on our estimate, in order to maintain our lifestyle, we need that amount of money in 20 years' time. Right? So clearly, this is a future value, projected the future value. Okay? And then if we understand this, there are a lot of interesting implications. Say, for example, if you are working as a financial planner, you talk to your client, right? And then if the client is saying this, and they need $2 million in 20 years, right? And then you should come up with an investment plan for your client. But in first place, we need to identify, clarify that this money is a future value, right? And our goal is how to achieve our objective not now, but in 20 years' time. Okay? Is that clear? All right. let's move forward. Okay? So when we deal with interest rate, or in other words, the time value of the money, there are two alternative mechanisms for the measurement. Okay? There are two different mechanisms can cause the value are moving, are changing, varying. Okay? So now for the rest of the class, we just go through each of the mechanism. Okay? So the first mechanism that moving the value, changing, is called the simple interest. Okay? Let's take a look. What is a simple interest? Okay? So for the simple interest, it's very simple. It's very easy. We just work with the initial capital or the principal capital for each cycle. Okay, so the base capital stay the same, right? And then we're just working on the same base capital for the interest component, right? And then the closing balance is going to consist the initial, the base capital plus interest component. Does that make sense? Okay, so that is a simple interest, right? And the second mechanism, which is a little bit complicated, it is called compounding interest or compound interest. Okay? So what is the distinction here? The key distinction is whether you are going to reinvest the interest. Okay? So every time after you collect the interest, then if you're going to reinvest the interest, then that means your base capital, your principal, is getting bigger and bigger, right? It's like you're rolling a snowball, right? The pie is growing, right? If that is the process, and then that means we are following a compound interest, okay? So let's just take a look at the definition, and then we show the calculation, the actual calculation, to deepen our understanding. Okay? So now let's just understand the key differences between these two. For the simple interest, the base capital always stays the same, but for the compound interest, the base capital is growing. Okay. Now let's take a look at the simple interest. Okay? And I also provide a reference for the formula sheet. Okay? So the formula is provided. Okay? And in addition, we can use whatever the software, the Excel or the financial calculator to solve the problem. Okay? But we provide a guidance, the reference where we can find the formula here. Okay? So the key here is to calculate the interest. Okay? And then we know that the interest is simply the product of the base capital, which is the principal, and then times interest, right? And then don't forget, we need to do a little bit of adjustment. The I times T here is we do the adjustment, we take into account of investment period, right? Because we always observe like the interest is quoted in terms of the year, right, per annum, right? But not necessarily our investment covers exactly a year, right? And what if our investment period only cover a fraction of a year? In this case, we have to adjust for the investment period, right? So we should always match the interest with the investment period. Is that clear? So that is the intuition behind, okay? And then to calculate the present value, we just need to work with the formula backwards. Okay? Do a little bit the reverse. Okay? So here we have two key formulas to calculate the present value and the future value. Is that clear? Can I move on? Okay. Here is an example. Okay. So suppose how much interest should I pay on $100 borrowing. Okay, for 3 months, 12% for the interest. Okay, so suppose here we are following a simple interest. So if the interest rate for the entire year is 12%, right? And then we can easily calculate, work it out. What about for a quarter? We just need to divide 12% by 4, right? And then we know that over a 3-month period, we are going to make not 12%, but 12% over 4, right? And that is a 3%, right? So as you can see, the first calculation is wrong, is incorrect. Why? Why this is wrong, is incorrect? So we are matching interest rate with the term. How long we invest? How long we borrow? 3 months. What about the 12%? That is per year. If you do this, then that means we are going to invest for 3 years, right? So here we have to do the matching properly, right? So we are matching a different unit of time, right? Does that make sense? Okay. What about the second one? The second one is exactly right. Why? The 12% is in terms of year, right? And then we can adjust our borrowing period, which is a quarter, in terms of the year, right? A quarter is exactly 0.25 year, right? And then we do the matching properly here, right? So therefore the calculation is correct, okay? And alternatively, rather than working on 12% per year, we can calculate the 1% per month. That is equivalent, right, for simple interest, right? And then here everything is in terms of the month, right? And then we can do the matching properly, right? So the tricky point here, the only tricky point here is just beware of the measurement, okay? We have to do the matching precisely. Is that clear? Okay, great. Now let's take a look at the a little bit complicated case for the compound interest, okay? There's nothing to worry about. I try my best to make everything as easy as possible and give you guys the intuition for the calculation, okay? If you understand the intuition, then you can handle all the calculations, okay? Right. And for the simple interest, let's just go back for a minute. So we can use Excel, of course, very easily, right? So suppose this is a future value, okay? And this is interest rate, 6%, right? And our time period is half year for 6 months. Therefore, time to maturity is 0.5, okay? And then we can apply the formula to calculate the present value, right? So what I do here is I just calculate. I use the formula and then do the calculation, right? And just use this formula, the present value formula, to do the calculation, okay? So what I do is I just manually type in all the numbers into the formula, right? And then we receive the answer, okay? So there's not much difference in this case using Excel versus using calculator, okay? But what I'm going to show you guys shortly is for the compounding frequency, there's a big difference. It's way convenient using Excel than using financial calculators, okay? All right. Compound interest, okay? And that will be the general formula to link all the components here. On the left-hand side, we have a future value, okay? On the right-hand side, we start with a present value. This is like the base capital at the beginning, okay? And then just take a look at here. We are following a power function. 1 plus r to the power of n. Okay? N here, the notation n here capture the length of your investment period, right? But why we are using a power function here? And remember, every time you collect your interest, you're going to reinvest that. So meaning you base capital for each interest making cycle is increasing over time, right? Therefore, the base capital, the principal is larger, is getting larger and larger. In order to capture this, we have to use the power function here, right? And if we understand that, if you work a little bit algebra, then we can solve the present value pretty easy, right? So that is just a reverse of the function. You have a question? Okay, great. Okay. So we just rearrange the equation, then we can basically switch. Okay, the right-hand side to the left-hand side. Okay, so we have a present value here, right? Here, you may, if you read the text, then you may find some terminologies here. When we are calculating present value here, basically what we do is we discount the future value back to an earlier day. So when you see the discount, that means we are working on the present value. Okay, we are working with a future value, but we are solving the present value here. Okay, so therefore we need to discount back the future cash flow backwards. Yes, please.
How come we minus number period?
Why is minus? Good question. Let's take the step by step. Okay, if that is the future value, the formula, right? So to calculate the present value, we have to shift 1 plus r to the power of n to the left, right? So you have exactly this. It's like 1 over 1 plus r to the power n, right? And that is equivalent to 1 plus r to the negative n. Okay? Right? So it is the same. Okay? Good. Okay, and then that will be the two, like the key formula to deal with the compound interest. Okay, one is for future value, the other is for a present value. Okay, and we already mentioned that. And this, when we calculate present value, it is called the discounting. Okay, we are discounting back the future value. Okay, backwards. Can we move on? Okay. All right. And on these slides, we demonstrate the differences between a simple interest, the mechanism, which is on the right-hand side, versus the compound interest mechanism on the left-hand side. Okay? As you can see, the key difference is that for the simple interest, the base capital always stays the same, right? But in contrast, for the compound interest, the closing balance for the previous period becomes our opening balance for the evaluation in the next period, right? And as such, we need to follow the power function for compound interest, okay? And on the Excel spreadsheet, I also do this a similar comparison, okay? So here the parameter is the same. So assuming the interest is 6% per year, okay? Right? And then we work with say the present value, the initial capital, $100. We want to compare the closing balance over time if we follow the simple interest mechanism versus the compound interest mechanism, right? And then I just do the calculation here and then just plot the answer. You can see there's a striking difference between these two, right? Okay, and for now, I also want to share with you how to use Excel to work with compounding interest, okay? Okay, let's just do a simple case for n equals 5 for 5 years later. That is what I'm trying to calculate the future value in 5 years' time. Okay, and with a 6% interest and $100 for the initial capital. Okay, so from Excel we can directly borrow a very convenient function. It is called future value. So the syntax, the code is called FV. So you just hit enter, right, and then type FV, and then followed by a bracket, right, and then you can see you have a menu, right, you have a dialog here, right. The Excel asks the following parameters. Okay, so the first one is what is the rate, right, then separate by the comma. The next one is NPER. What is the NPER? Number of period. Okay, right, and then so on and so forth. I will demonstrate what are those key parameters here. Okay, for the rate, I can manually type in 6%, right, or alternatively, I can tell Excel, please use that number. Okay, what about an NBER? I can click, or I can type, right, 5. The next parameter here is called PMT. It's called payment. We don't need to worry about this parameter for today's class. That means, what about the interim cash flow during the investment cycle? We don't have any interim cash flow here. We're only evaluating a single payment, right, cash flow. So we can type 0, or we can skip. Okay? So we can type 0, or we can just simply skip. Okay? And then for the present value, I need to tell Excel, please use that number. Okay? And then for the final parameter type, we don't need to worry about that for today's class. Right? And then you can just close the bracket, right, and then return the answer. It's convenient, super convenient, right? And you're probably wondering why you type a negative 100 at the beginning, right? The answer is when the algorithm, okay, the way Excel handles the situation is they want to treat the initial present value as a different sign with the future value. So such that the initial value is like a cost, cash outflow. The future value is cash inflow. So they have an opposite sign, right? If you use a positive number at the beginning, then you can see the future value will turn negative. They always have a different sign, right? We can easily use absolute value to convert, to transfer this negative, to take into account of this negative sign. But our key point is we can borrow Excel function directly to solve financial problems. All right, is that clear? All right, and then another key message here is you can see there are huge the differences as time is moving. You can see the gap between the compounding interest rate mechanism is so different from the simple interest compounding. The economic reason is the base capital is getting larger and larger. We grow our pie over time for the compound interest mechanism. Okay? So I even do a simple comparison for a shorter period. Only for 20 years, 30 years, you can see the difference. Okay? And now I want to give you my 2 cents. So here, all our calculation is based on a very reasonable figure, 6% per year, right? And then you can see the difference if we make an investment for 20 years, right? So what sort of implication we can learn from here? So after you guys finish uni, after you have your salary, think about some investment decision, right? Just be patient, right? If you invest on stock market, on average, we are making like 7%, 8% per year. I'm not talking about the individual stock. I'm talking about if you invest like index fund, okay? Invest on the entire stock market, okay? On average, I'm talking about on average, we are making 8% per year, right? If you're continually doing this, you can see over time, right? You can see how much we can expect at retirement, right? So here we can see a good example. Based on a very reasonable figure, 6% per year, if you live to the time, if you live to the market with compounding mechanism, you can see the accumulation of your wealth, right? Okay. Okay, let's move on. And here is we can do another comparison among a different interest rate. You can see if we work with a 0% interest. What's that mean, 0% interest rate? We don't have any time value of the money, right? So value of $1 today is $1 tomorrow. As you can see, the value function stays flat, right? But as long as we have an interest, you can see the value function between a concave, right? It's upward sloping, it's concave. As the interest rate is getting higher and higher, then you have a steeper growth rate, right? You can see the future value grows exponentially, right? Okay, so I'm just do a simple calculation here. One is for interest equals 4%, the other is 6%. As you can see, in 1 year's time, the difference is not that much, right? But only with 2% differences, you can see the gap is getting larger over time, right? So if I repeat the calculation again, or if you have a laptop, you can also practice, right? So how to calculate the future value? We borrow the function FV, right? So rate here, the rate, you need to tell Excel what is the interest per cycle. Okay, I'm gonna demonstrate why it is important. Okay, but for the time being, let's just type the interest. It's a 6%. But please remember, the figure we input should be the interest per cycle. Okay, not necessarily we are making interest every year. We may have a different frequencies. But for this example, let's just type in 6%. Okay, number of period, say, for example, I'm interested to know about what about in 15 years, okay? What about PMT, 0, right? Where we can skip. We use 0, right? And present value, $1,000. Okay, as you can see, if I use a positive number for present value, then for the future value will be negative, right? Because they impose some conditions here. All right, and here you can see the differences between the interest rate, the 4% versus the 6%. Okay, so by the way, after today's class, I will also upload my spreadsheet, right? And then you can take a look and then practice, and maybe you can try to replicate all my calculation yourself to practice some modeling skill. Okay. And we can also work with the formula oppositely, right? So we can work with the future value and then calculate the present value, right? So that is a very straightforward. What I want to demonstrate, share with you guys is how to use Excel for this, okay? If Excel can handle the future value calculation, then we should expect the same for the present value calculation. And indeed, we have a similar function from Excel. It is called present value, right? So what should I type? You probably you already know the answer, right? So what I need to type is PV now, right? And then the format of this function is pretty similar, right? Ask the same question. First, what is the interest rate per cycle? Okay? And suppose we are working with the 4% interest rate here. And NPER in 100 times, in 100 years time, okay? And the payment, we don't have any cash flow. We can type 0, and the future value is this one, $1,000. So that means we are calculating $1,000 to be received in 100 years' time. We want to discount back that $1,000 to be received in 100 years' time. Calculate the present value as of today. Is that clear? I just want to clarify and those terminologies. Okay, right? And then we can hit the enter. Only $19, right? So that is a true economic value of receiving $1,000 back in 100 years' time. If we assume interest rate stay flat at 6%, right? If I'm like a salesperson from a financial institution, I try to sell you a product. Okay, that is a question for you guys. I'm trying to sell you a product. The product promises to pay you like $1,000, but in 100 years' time. Okay? The question is how much you should pay. My question is, should you pay $20? Any suggestions? Any idea? How do we make the decision? From our calculation, the present value of receiving $1,000 in 100 years' time is at how much? $19.80. How do we interpret that number? That is a true economic intrinsic value of receiving $1,000 in 100 years' time, right? So the fair price in exchange for this financial product is only at $19.80, right? If it is selling at $20, it is called it's overpriced. So as a rational investor, we should never buy an overpriced stuff, right? But what if now it's selling at $18? The market price is below the intrinsic value, right? You pay $18, but you are receiving effectively $19.80, right? So now it's undervalued. Therefore, we should buy it. It's undervalued, right? So that is the implication we have here, okay? And then what I do is, if we are calculating the same $1,000 over time, right, and then calculate the present value today, that will be the present value function. You can see the present value is decreasing over time. As we are staying apart from the present the future value, we can expect a smaller the present value today. Okay, that reflects the compounding interest mechanism. Okay, and then here on the slides, we just have a different examples here. Okay, with a different the maturity. Okay, so on my spreadsheet, I already cover all the different the maturities here. Okay. Okay. Now let's talk about the different frequencies. Okay. Remember, we just mentioned if you are using Excel, the first parameter interest, it is an interest per cycle, right? So we have to take into account what if our interest making cycle is different from a year. Okay. Now let's just do a practice. Okay. What is the future value of $100 deposit for 2 years if we observe the nominal interest rate is 8%, but the interest is paid semi-annually, meaning twice a year. Quarterly meaning 4 times a year, right? And weekly means 52 times a year, right? And that means we are just receive interest more frequently, right? While the interest is quoted in terms of the year, but the actual receiving cycle is much frequent than the quoted one, right? Now let's take a look at the implication here. Okay? So if we are using the formula, here we go. For a semi-annual case, right? Just take a look. Remember, the interest we are working with should be the interest per cycle. Well, we know it is 8% per year. What about the per cycle? We are making interest every 6 months. So how much we are receiving every 6 months? It's half of it, right? So it's going to be 4% per cycle. That makes sense? Right? And then if we do the adjustment for the interest, we should also adjust the term, right? For 2 years, how many investment cycle, interest receiving cycle we deal with here? That will be 2 times 2, right? So in total, n equals 4 here, right? And then we can easily follow the formula, and that is the future value, right? But what I want to show here is using Excel. Okay? So I'm working with the same, the initial capital $100 and maturity equals 2, but we just change the frequencies here. Okay? So we have a quarterly, semi-annual frequency, the quarter frequency, and the weekly frequency, right? And even we can extend the scenario a little bit. We can also introduce the daily frequency. Okay? Let me just show the approach. How do we do it systematically? Okay? So what I want to do is always identify and do some alignment. The alignment is we need to make sure that the interest aligns with the time, NPER, the number of period, using the Excel language, okay? So now, if we work with a semi-annual compounding, right, and that means for each interest making cycle, we are receiving 4%, right? So that is this number divided by 2. We have a 4%, right? What about the investment cycle? We invest for 2 years. That means we're going to have 2 years times 2, right? So we have a 4 investment period, interest period, compounding period, right? And then what about the future value? I'm just using the function, right? The future value, what is the rate now? Should I use 8%? The answer is no, right? Because here, for this product, we are receiving interest twice a year, right? So we have to use the right number here, 4%, right? What about the NPER equals 4, right? For the payment, it's a 0, right? And then for the present value is here, right? And then you can work with a quarterly scenario. What I do first is I always calculate the interest per cycle, okay, for each compounding cycle. Do the adjustment first before you put a number into the formula. Is that clear? Right? And then you can work with the quarterly compounding and weekly compounding, right? So we can follow the same approach. Do the adjustment first before we input a number into the function, okay? So now let's do a comparison. There are some interesting story here. Okay? So here is Remember, we are working with the same principle, $100 at the beginning, right? We are working with the same interest, the nominal interest, the 8%. We are working with the same investment horizon for 2 years. The only difference is what? The frequencies. Okay, so how frequently we are receiving the interest. Okay, but the outcome is different. So meaning what you see is not really what you get, right? So what, any comment? What is the pattern for the number, ending number? As they're moving along the row. Here, if you look at the column G, I'm even calculate the daily frequency. So meaning we're going to be paid the interest on a daily basis, right? So any pattern here? So I'm calculating the daily frequency, right? So I can do the adjustment pretty easily, right? So here, the interest per cycle will be 8% divided by 365, right? And NPER, 365 times 2, right? And then I just follow the same calculation, right? And what I can even calculate is hourly compounding. We're going to be paid every hour, right? And every minute, right? We can also calculate every second. Let's just take a look. Is there any pattern here as we are only change the frequencies, okay? So meaning, as we shorten the compounding period, as we are moving from like semi-annual compounding to the quarterly compounding, to the weekly compounding, to the daily compounding, the future value is increasing, right? Why? Any thought? The key explanation is that now we are working with a new base capital more frequently, right? And then we're going to reinvest whatever we collected during each cycle, okay? And there's another clear pattern here. So that means every time you shorten the compounding cycle, you're moving from a yearly compounding to semi-annual compounding to quarterly compounding to daily compounding, the value is increasing. So should I expect this value becomes infinite if I keep doing this? The answer is no. We already see a hard evidence, right? While the value is still growing, but the speed of growing is decaying, right? Finally, that will be capped, right? So it will become a flat, meaning there is an upper limit for this growth. And such that whenever if you keep shorten the interest compounding cycle, it doesn't affect the value, the future value calculation anymore, right? But I don't want to go too deep. This will be covered in your second year finance, right? And this process is called the continuous compounding process. So meaning we're going to make interest every instantaneously, right? It's called, economically, it is called the continuous compounding, okay? Okay, so from here, we see clearly, while working with the same interest rate, but what we see is not what we get. Why? Because we need to bear in mind the frequencies. Frequencies matters a lot, right, in finance. Okay? Now let's talk about this, right? And then we're almost done for today's class. Okay. All right. So nominal interest rate versus effective interest rate. Why it is important? We already showed that the frequencies matter a lot. What we see is not what we get in some circumstances, right? And in this case, we need a consistent measurement approach to translate different frequencies into a systematic approach. Okay? Say, for example, here I'm making two offers. Okay? So one is at 10.3%, but compounding annually once a year. Okay? And second, I offer you 10%, but compounding monthly. Okay? As you can see, working with the same base capital, the future value is different. Right? And strikingly, it is actually the 10% scenario provide a better future value. Right? And in this case, it seems that we cannot make an easy decision just based on the interest rate, right? Because the frequency matters a lot. So the question is, how do we make an informed decision then? So for this purpose, we need to introduce a consistent measurement. It is called the effective annual rate. Okay? So the question we want to answer is, effectively, what will be the interest rate if the interest is only paid once a year? And that gives you the same equivalent outcome. Is that clear? Now let's work it out. Okay? For a 10% scenario, it is the same because the 10% will be paid once a year. Okay? So here on the left-hand side, we try to solve the effective annual rate. What will be the equivalent interest rate if it is only paid once a year? Okay? On the right-hand side, it is whatever you observe in the market, the nominal interest rate. So I equals 10%, right? And M is basically the compounding frequency, right? And M here equals 1, right? And then we know there's not much difference here, right? Now let's take a look this comparison. 10.3% is paid annually, right? So there's no adjustment needed, right? What you see is what you get, 10.3% per year. But for this case, 10% is going to be paid monthly. Remember, we need to calculate the interest per cycle, right? So on each month, we are making 0.10%, 0.1% over 12. That is the interest rate we are receiving every month, right? Remember, we are trying to calculate what is equivalent interest for the whole year, right? Then we're going to invest that for the whole year. In a year, there are 12 investment compounding cycles, right? And here, if you follow the formula, effectively, we are receiving 10.47%, right? And since we are comparing effective annual rate versus effective annual rate, right? Then we can make a meaningful comparison. It is clear we should go for the second one. Why? Because the second one, the monthly compounding rate, while the nominal rate is slightly lower, but in terms of the effective annual rate, it is much better. It's better than the first one, right? Remember, the key reason is what you see is not what you get, because the frequency matters a lot. Therefore, in order to make a meaningful comparison, we need to calculate the annual effective annual rate. Okay? Now, let's talk about the multiple cash flows. Okay, so that is the final part for today's class. Okay. So, in this example, I'm giving you alternative choices, right? So product A offers 3 sequential cash flows. Okay, you can receive $200,000 now, and plus $500,000 in 1 year and $300,000 in 2 years' time. Okay, so that is called product A. Alternatively, I can offer you a lump sum payment today, $910,000 now, right? So as a finance student, by completing today's class, you should make a better decision which one we want to go for, right? So the question is, should I sum it up for those three cash flows? Should I just simply sum up 200 plus 500 plus 300? Is that right? The answer is no. Remember, the value tomorrow is not a value today, a dollar today. So we have to take into account the economic value of those cash flows, right? But the only hurdle here is we involve three different cash flows, but it doesn't really matter, right? So we can work with those individually, each of the future cash flow individually, and then transfer those value into today's value, right? Let me show you the process, right? So first, we should always write down the value along the timeline, right? And in relation to the timing. Timing is important, okay? Right? And then basically here, we want to solve the total present value of the entire cash flows, okay? So in order to do this, we need to calculate the three present values separately, okay? Of course, the first one, $200,000, occurs today, right? So not much calculation needed. A dollar today is a dollar today, right? But the difference is for the first year cash flow, we need to calculate the present value, right? By taking into account, we need to discount those future cash flow backwards, right? And then the total present value should be like this. Is that clear? Okay. And we can also solve the question with Excel. So what I do here is I create a summary table. Okay? So I write down the cash flows. And along the cash flows, I also specify the timing of the cash flow. 0 means today. Okay? T equals 0 means today. What I want to calculate, it is a total present value of all cash flows, right? And remember, we cannot use the present value function. Why? Because the cash flow doesn't stay constant, right? Then we have those randomness with cash flows. But we can still borrow Excel functions. It is called NPV, net present value, okay? NPV. So the first parameter you need to tell Excel what is the interest rate, okay? Here, the interest rate will be like, what is the interest rate here? 10%, right? And then you need to tell Excel what are those multiple cash flows. Bear in mind, note it, we need to pay attention here. While we observe the first cash flow immediately from today, from T0, but Excel can only handle the first cash flow from T1, from year 1. Okay, that is important. So meaning, in order to get Excel do this calculation, we can only start work with this value, these two values, because the first value occurs at T0, right? So what we do is I just select those cash flows, right? And Excel return me the figure, but we're not yet finished. Why? Because we still have $200 at the beginning, right? And then what I do finally is I just add $200 today. They're all today's value. 702, it is a total present value as of today for the remaining two cash flows, right? Now the timing is same as today, right? So the total present value will be 002, right? So the function we are dealing with here is called a present value, okay? And there's another point, small issue we need to bear in mind. If you're using NPV function, you have to make sure that the cash flow are continuous, right? For example, if $300 occurs in year 3, and we have a 0 for year 2, you cannot omit 0, 2. Rather, you have to use a 0 to replace those no cash flow year. Okay? Because Excel cannot tell precisely the timing. They assume all cash flow occur continuously. Okay? We can also calculate the future value of multiple cash flows, right? Here, again, I strongly recommend, as a first lessons on this, please always write down the cash flow on the timeline, right? And here we are calculating the future value, right? Then we need to look at the time space between the evaluation period and the ending period. So here we are working with cash flow individually. For the first cash flow, we are 4 years from year 1 to year 5, right? So n equals 4, right? While the first item occurs in year 1, but when it comes to our calculation, we know that there are 4 years distance between $1,000 and the end of year 5 evaluation period for the future value, right? If you understand this, you can easily calculate all the future values, okay? And I just want to share with you, maybe there's a smarter way to calculate the future value. Let me just quickly go through that, and then we finish the class. Okay? So here is example. Of course, we can calculate the future value individually for each of the component, right? So I just calculate the future value for cash flow 1, cash flow 2, 3, and 4 individually. And now the total future value will be summation of those 4, right? But alternatively, I just wanted to borrow a convenient Excel function for this purpose. But what I do first is I don't calculate future value. Instead, I calculate the present value. I just want to translate all the value back to T0, right? Why? Because we can use the NPV function directly, right? So here, I just calculate the NPV, the present value of all cash flows, right? But that is not what we are looking for. We are looking for the value at the end of year 5, right? And then what we do is we take the present value on board, travel with time machine for 5 years, right? And then what I do next is I just calculate the future value, right? So I can just borrow the future value function for this, right? NPER equals 5, 0 payment. The present value is here, right? And then I receive the same answer, right? It doesn't really matter which direction you want to go for, right? Because the value are changing over time. It's all defined in first place. If your calculation is correct, you can calculate the present value and then freely move along the timeline, right? So here, rather than calculate the individual future value one by one, I can do the alternative. I can calculate all present value together in one single calculation, right? And then calculate the future value for the whole lot in one step, right? And I leave it to you which method you prefer. But the big picture for today's class is we introduce the time value of the money. We provide the conceptual explanation why money has a time value, and we also clarify the measurement issue, right? And thank you very much for your attention. I look forward seeing you in our seminar. Thank you, guys.